All right, let's just jump right in. When we talk about saving for retirement, we tend to think about the flashy stuff, right? Picking the perfect stock, timing the market, chasing those huge returns. But what if we're all looking in the wrong direction? What if the single most important factor in your financial future isn't what you buy or even how much you save, but simply when you get started? Today, we're going to pull back the curtain on the real, hard numbers behind the cost of waiting, and we'll see how time can be your best friend or your absolute worst enemy. And it all starts with this one idea, this almost magical concept: compounding interest. It's like a tiny snowball at the top of a really, really long hill. At first, it's slow. You barely notice it picking up any new snow. But the bigger it gets, the more snow it grabs with every single turn, and that growth starts to explode. That's your money. Compounding is the engine that lets your investments build on themselves, turning a little bit of effort now into a financial avalanche later on. It's the secret sauce that lets your money do all the heavy lifting for you. So if compounding is this incredible eighth wonder, then waiting, well, that's something else entirely. It's like a silent, invisible tax on your time. You won't see it on your paycheck. You won't get a bill in the mail. It's a tax you pay in lost opportunity. Every single year you wait to get that snowball rolling is a year you are paying a massive penalty. Not in dollars you can see today, but in the growth you can never, ever get back.
And the difference here is truly jaw-dropping. We're not talking about a small, little change. No. The gap in wealth between someone who starts in their 20s versus the 30s is absolutely massive. It can be the difference between a retirement filled with choices and one filled with stress. Let's actually look at an example so you can see what this unseen tax really costs. Okay, so check this out. Let's call this guy Jack. If Jack starts putting $5,000 a year into an IRA when he's 22, and he gets a pretty average 7% return, by the time he's 65, he's got just over $1 million bucks. Pretty great. But what if Jack waits? He's busy, life gets in the way, and he starts at age 32. Same $5,000 a year, same 7% return. The result? He ends up with around $450,000, less than half. Let that sink in for a second. That 10-year delay, where he only put in $50,000 less, cost him over $500,000 in the end. That is the brutal, unforgiving math of lost time. So what's the magic behind that crazy chart? It's this right here: compound interest. It's so simple, but it's so powerful. It's not just your original money that's working for you. It's the interest that starts earning its own interest. It's a feedback loop that gets stronger and stronger over time. That's why the growth curve goes exponential. And it's exactly why those first few years are so incredibly, almost unfairly important. All right, let's keep going. Now, you'd think after seeing that, everyone would be rushing to invest, right? But a lot of people don't. And usually it comes down to one thing: fear. Fear of the market going down, fear of losing money. So they choose what feels safe. They just let their cash sit in a bank account. But what we're about to see is that this feeling of safety, well, it's mostly an illusion. This is the question we have to ask ourselves. What does safe even mean? We think it means the number in our bank account won't go down. But is that it? Or does safe mean protecting our ability to buy stuff in the future, our purchasing power? Because trust me, those are two very, very different things, and confusing them is a recipe for disaster. And here's the cold, hard reality. The money in your savings account, it's earning next to nothing, maybe 0.1% if you're lucky. At the same time, inflation, the rising cost of everything, is chugging along at around 3.6%. Just think about what a gallon of gas cost a few years ago versus today. That's inflation. So by keeping your money in the bank, you're not standing still. You are on a downward escalator, guaranteed to lose purchasing power every single day. And the risk is actually bigger than just inflation. It's something called systemic risk. When you hold all your money in cash, you're making one giant bet on a single thing: the long-term stability of that currency. You have zero protection if the value of the dollar changes or if there are big economic shifts. So by trying to play it safe, you've actually made yourself totally vulnerable. Okay, so sitting on cash is a guaranteed loss. The obvious answer then is to invest, right? Just put it all in a diversified portfolio and play the long game. That's what they always tell us. But what if the long game isn't a guarantee? What if the classic buy and hope strategy can leave you stuck in the mud for years or even decades? Just take a look at this. It's a bit of a horror story. This is the NASDAQ during the dot-com boom. Imagine you invested right at the top in 2000. Then you watch it lose over 75% of its value. But you're a long-term investor, so you hold on. You wait. You claw back a little, and then bam, the 2008 financial crisis hits and wipes it all out again. By 2013, a full 13 years later, you still weren't back to where you started. An entire decade of your financial life just gone.
And this quote right here, this just nails the human side of it all. It's not about the numbers on a spreadsheet. If you're 50 years old and it takes 13 years just to get back to even, you're now 63. Yeah, you got your money back, but you lost 13 irreplaceable years. 13 years where that money did nothing for you. You can't get that time back, ever. So at the end of the day, the standard advice is really just a bet. It's a hope. It's a gamble that the market is going to be rosy on your specific timeline. You're just crossing your fingers that a lost decade doesn't happen right when you need the money most. But history shows us things aren't always rosy. Being a passive passenger means you're completely at the mercy of those cycles. So this all sounds pretty bad, I know. Waiting is a penalty. Cash is a guaranteed loss. Even buy and hold can fail. So what are you supposed to do? Well, this is where we pivot. This is the moment where we stop being a passive passenger, just hoping the bus goes where we want it to, and we learn how to become an active driver. It's about finding ways to make time your ally, no matter what the market is doing. Just let that question sink in for a minute. Everything we've talked about so far treats time like an enemy, right? Inflation eats your money over time. You wait for the market to recover over time. But what if you could flip the whole script? What if the simple, predictable tick-tock of the clock could actually become a source of income? It's a huge idea, and it's at the heart of a much more active way of thinking. It's possible because of a concept from options trading called time decay, or theta. Now, don't let the name scare you off. The easiest way to think about it is like this. Some financial products, like options, have an expiration date, just like a gallon of milk. A concert ticket for a show that's 6 months away has a lot of time value, but the day before the show, that time value is almost completely gone. That erosion of value, just because time is passing, that's theta. And here's the real kicker. This decay isn't a straight line, not even close. When an option has months to go, the decay is super slow. But as it gets closer to expiring, the decay speeds up. And in that final month, it's like an ice cube melting on a hot sidewalk. It just vanishes. Smart investors can position themselves to be the ones selling that melting ice cube. They literally collect that decaying value, getting paid as the clock ticks down. They turn time from an enemy into an ally. Now, to use a tool like that, you need more than just a new strategy. You need a completely different mindset. And there's really no better way to understand this than by looking at the famous ideas from Rich Dad, Poor Dad, which breaks down two totally different ways of looking at money and risk. This chart just lays it all out. The Poor Dad mindset, which is how most of us were raised, is all about avoiding risk. Play it safe. It says your house is your greatest asset. The Rich Dad mindset flips all of that upside down. It's not about avoiding risk, it's about learning to manage it. And it has a very different definition of an asset. An asset puts money in your pocket. A liability takes money out. So by that logic, your house, with its mortgage and taxes and upkeep, it's a liability. That one idea alone is a complete game changer. And that mindset leads to the ultimate goal, something that sounds like a fantasy, the infinite return. But it's just math. Here's how it works. You find an asset, like a rental property, that produces enough cash flow to cover all its own costs, including the loan you took out to buy it. Once you've paid yourself back your initial investment, you have zero of your own money in the deal. From that day forward, every single dollar of profit is, mathematically speaking, an infinite return. That's the holy grail. So we've gone from the high cost of waiting to the illusion of safety and all the way to a completely new mindset for building wealth, which brings us to the final and, without a doubt, the most important piece of the puzzle. What is the single most powerful asset you could ever possibly own? Because when you choose to wait, when you sit on the sidelines, you're not just losing one thing. You're getting hit with 3 different kinds of losses. First, there's the obvious loss of time, the fuel for compounding. Second, the loss of capital, money that goes to liabilities instead of assets. But the third loss, the one that hurts the most, is the loss of education. By doing nothing, you learn nothing. You lose the experience, the lessons from your wins and your mistakes, and you never build the skills you need to win. And that is the absolute key. Your 401k is not your greatest asset. Your house is not your greatest asset. The only real permanent asset you truly have is your mind. Investing in your own financial education, learning how money actually works, how to manage risk, how to spot an opportunity. That is the foundation. A stock can go to zero, a market can crash, but knowledge? That's the one thing that no one can ever take away from you. So look, here's the bottom line. Time is ticking by whether you do something or not. That eighth wonder of the world is either working for you or its absence is slowly working against you. The cost of waiting is real, it's huge, and it isn't just measured in dollars, but in lost years and lost knowledge. Your entire financial future is being written by the choices you make and the choices you don't make right now, today. So, what's your next move?